Good day once again. Back in business, back in classroom, all about investment analysis and portfolio management. We are almost 1/3 into the course, to these lectures, and we are in a position to now talk about investments as a subject कि आपने काफ़ी ज़्यादा इंसाइट इस वक्त तक हासिल कर ली होगी in lectures से. I can assure you this is real knowledge that you are going to get. This is knowledge that you're going to be able to use by yourself to get into better lifestyle. Whether you apply this knowledge to yourself or you apply this knowledge as a means of getting into a job or beginning a business. We talked about valuing markets, and we talked about applying fundamental analysis in valuing markets. Obviously, we're talking about these informations coming in as sources of information for investors to make decisions based on these knowledges so that they can make a gainful investment. And then we would understand the required rate of return needed by investors while valuing markets. Now, the steps in estimating earning streams would include GDPs or gross domestic products, interest rates, taxes, and the like. We talked about earning multipliers, and the most popular of them all, the price earning multiple. This remains the most popular. We talked about it in relationship to the industry averages, and we discussed that the S&P 500 past PE average was something like 14 in a period between 1928 and 1995. We talked that the price earning multiples tend to be high when inflation and interest rates are low, and price earning ratios tend to be low when inflation and interest rates are high. So, we must understand the volatility in markets because it's difficult to predict. We talked about forecasting changes in the market. Now, it is difficult to consistently forecast the stock market, especially in the short term. We talked about the efficient market hypothesis states that future cannot be predicted based on past performance and past information. Although market timing is difficult, some situations suggest strong action. So, investors tend to lose more by missing a bull market than by trying to avoid a bear market. We also talked it's not a good idea to trade against the trend. Now, using the business cycle to make forecasts, we understand that there is a leading relationship that exists between stock market prices and the economy. Can the market predict it by the stage of the business cycle? We consider business cycles as turning points well in advance before they actually occur, which would mean that total stock returns could be negative when business cycles peak or positive when business cycles bottom. The art is trying to find out the best, nearest tops and bottoms and positives and negativities in business cycles so that we can do gainful investments. These business cycles have a time frame, and these help us in making good, timely decisions. So if investors can recognize the bottoming of the economy, there before it actually happens, a market rise can be predicted. And we can switch into stocks out of cash because we were flush with liquid, because we were waiting for such an opportunity. As economy recovers, stock markets may level off or even decline when it actually does happen. So, based on past, the market price earning multiple usually rises just before the end of a slump. Remember, we talked that stock prices tend to stay ahead of actualities actually happening and then coming into shape when actualities really do occur. So they take the shape of the economy which they first led by way of their stock movements. Taking advantage of using key variables to make market forecasts, we talked about the best known, most popular variable, the price earning multiple, but we did also talk about other indicators like dividend yields and earning yields. But the problem with key market indicators is, question is, when are they signaling a change? How reliable are the signals? And how quickly will the predicted changes occur? That are problem areas with key market indicators, because it's about timings, and if you can't get the act together because of right timings, we might be in for some rather rude surprises by way of erratic price movements, not behaving like we would want to. Now, central bank activities and government level activities at the fiscal and monetary level have also got their own bearings. So, asset allocation changes imply the returns on equity and fixed income securities are related. Compare a 10-year treasury yield with the earnings yield on the S&P 500, and we conclude that earning yields, if greater than T-note yields, will imply that stocks are attractive. And if earning yields are less than T-bill yields, we assume that stock market prices are unattractive. Now, these are the problems that we must understand. The earnings that are estimated in the future, losses, reliability when rates are low. So market forecasts are not easy by nature and are subject to trial and error. Investors should count on the unexpected occurring. They should be prepared for any other eventuality than they were really thinking about. Intelligent and useful forecasts of the market can be made at certain times, at least as to the likely direction of the market. We try to be hitting the market predictions as close as we can. If it's not the bullseye, at least we should be aiming near the bullseyes to get our figures correct, so that our investments are in the right direction, in the right industries, and in the right shares. So, while doing that market macro analysis, we came to deciding that we also need to do a sectoral or industry analysis as well, because this is the second step in fundamental analysis of common stocks. So, industries promising the most opportunity in the future should be considered as the industries where you should invest. And concepts of industry analysis related to valuation principles. The continual analysis due to inconsistent industry performance over time has to be looked at with a keen eye. We must understand that we should be doing a continual analysis of the industry, looking at its past performance in relation to the current standing of the industry. Now, while doing industry performance over time, we must understand the potential value of industry analysis as seen by assessing the performance of different sectors and different industries over time. In this context, the S&P's monthly stock price index over a long time period shows industries will perform differently over a period of time. So, stock performance is affected by the industry performance, and then industries in decline should be avoided, because we talked, if the industry is going south, there's less likelihood of an individual stock going north, because the industry as a whole is going to dictate the company. While the industry would be referred to as macro, common stock would be referred to as micro. So consistency of industry performance is paramount before we can even think about a single common stock. And maintaining our positions in growth industries leads to better returns than otherwise. Now the question is, can industry performance be predicted reliably on the basis of past success? That is the big if. We did mention that history tends to repeat itself. We did talk about growth industries focusing over good earning potential results, looking at the previous track record, but there are no guarantees. But we can understand that a consistency in industry performance has to be weighed in with seriousness. Now, this led to a question: what actually is an industry and what industry classifications are? But industries cannot be classified or identified. Diversified lines of businesses cause classification problems. Now, these industries continue to become more mixed in their activities and less identifiable with one product or service. Since diversification is more important, we need to understand that classification sometimes becomes difficult. So, we will consider looking at the industries and its performance as an identifiable product provider or service provider. Now, help is there in trying to classify the industries, and the standard industrial classification that is based on census data and on the basis of what is being produced by the industry. So the standard industrial classification has around 11 divisions using alphabets A through K, in which each division has been assigned and has several major industry included in it. These are designated by 2-digit codes. Larger the number of these digit codes, more specific the breakdown of the industry classification. We do have other classifications as well, the S&P and the value line. But once again, these classifications tend to be dicey. Now, while we are talking about analyzing industries, we must understand that we have to analyze them by a certain methodology. So we can do that by stages in their life cycle. All industries have life cycles, and all life cycles have stages. So we try to identify industries by looking at their stages, but this helps determine the health and future prospects of the industry. One of the factors or the stages that we must look on is the beginning or the pioneering stage. That's where the action starts in the beginning. Now, because the industry is new, because it's the beginning, it's the pioneering stage, there is rapid growth in demand. But that's just in the beginning. And there will be opportunities that may attract other firms and venture capitalists to the industry. But it is difficult to identify eventual likely survivors. We have a likelihood of having a mad rush towards a certain new industry coming up on the canvas, but with time, we will notice that the interest will tend to taper off, and we really don't know what survivors' numbers are going to be. Whatever is going to begin is going to be success in the end. For every company that's coming up, for every industry that's being introduced, as many as same number or double those numbers are dying out as well. So the likelihood of trying to find a company or industry at the pioneering stage is rather difficult. Now, these pioneering stage can give you a good idea of where to think about investing. All pioneering stages are very exciting in the beginning. But that does not necessarily mean that you are going to be able to find out the best industry at this early stage. since this pioneering stage is going to develop into a certain other stage by the time the industry is trying to mature, and we might find that the pioneering stage was just a fad and may have the potential to fizzle out. Now, if we've been talking about pioneering stages, we would look at the next stage then, which would be the expansioning stage of the industry. If we were to look at the expansioning stage, or let's say the second stage, we would look at the survivors from the pioneering stage. How many began the race in the industry, how many fell in between, and then who were the likely survivors from the pioneering stage. Now, while in the expansion stage, we look at firms' operations are more stable, more dependable, because they've been weathered because of intense competition, and they were able to survive because of better operational capacities, and they became more dependable. While we're talking about the stage, we understand there is considerable investment funds that are attracted at this stage, because those venture capitalists or investment opportunists are waiting on the sidelines to look at how a company is maturing. They will not jump in at the pioneering stage. They will wait for the expansion stage. Now, financial policies are by now firmly established. A direction has been set by the companies, and then you can look at dividends being visible. Dividends often become payable at this particular stage. And then at this particular stage, at the expansion stage, the company becomes visible and attractive to investors. Because this is the stage where companies tend to become more obvious than other companies, because they have gone through a lot of rough and tumble at the pioneering stage. There's been a lot of elbow hitting, and you get at the level where the better company survives. Obviously, we're talking about companies with more potential to deliver in form of product, in the form of potentials of service deliverabilities, and be in a dividend paying capacity. We talked about investments in societies, investments in corporations, investments in commodities, investments in human resource, which will be delivering you positive results. We said in the beginning that investments is for capital gains and to supplement your income. So unless you can find a company that is in a capacity to pay you dividends, then only you'll have the likelihood of investing in such a company. So once we've gotten over the pioneering stage or the stage of expansion, we'll look at the maturity stage, or the word that we can use is stabilization stage. So growth begins to be moderate at this stage, the stage of maturity. And then growth will also be seen at as a place where there will be a marketplace full of competitors. Now, when we have competition, these companies which have become mature will have the capacity to bear the competition. And then the costs start becoming more stable, and in fact, they become to a stage where maybe a decline in costs. Since things have settled down, these stages become important stages. But there are limitations of life cycle approach. There has to be an end to all the excitement, and a generalization that may not always apply. You have to be specific. Tends to focus on sales, market share, and investment in the industry. So we go through the pioneering stage, we look at the expansioning stage, and then we find out whether a company has really gone into the maturity level that we will need a company to deliver for a long period of time. We see a number of herd mentality investment opportunities by people coming up and putting up one industry which is already overloaded with flush with other companies in the same sector, but maybe the homework has not been done properly and people rush in to set up the same industry. It might look good from the outside. The neighbor's garden is probably more greener than yours, but that's just from the outside. You might be in for a surprise once you get into the industry cycle. So, what would be the implications for stock prices of such industries? The function of expected returns and risk has to be weighed. What are you going to take a risk for? Whether you're going to get a good result. So in the beginning, in the pioneering stage, you are offered the highest potential returns and obviously the greatest risk, because nothing has been established at the pioneering stage. So you may be in for a great deal of profits, excitement, good hopes for the future, and then investors interested in capital gains should avoid the maturity stage. If somebody is getting into the pioneering stage, you would think of getting out at the expansionist stage and not wait for the maturity levels to come. So the expansion stage is of most interest to investors, where growth is rapid and orderly. Now, all things end up nicely or badly, but the important thing is that you must understand that we are here to make investment opportunities lucrative for us. If you're making good money, you must get out of the market when the going is great. The market I had mentioned is a combination of greed and fear. You have to decide what your required rate of return is. One of the principles of understanding stock market and fundamental analysis, you must know what your required rate of return is. There can be no infinite waiting for infinite returns on your investment. There has to be a limitation. So, if you set your standards, if you set your parameters, and you've set your objectives, and you've set your goals, you would know when to get out of the market. You're not going to be getting out exactly on the top. You're not going to get into the market exactly at the bottom. And if somebody is saying he got in at the exact bottom and got out at the exact top, is probably lying. You probably get inside at around the bottoms and try to get out around the tops, and you still make a good killing. Now, did we talk about qualitative aspects? There has to be a qualitative aspect as well. An aspect where we look at the historical performance of the industry. When we're talking about the historical performance, we're talking about historical record of sales and earning growth as a qualitative aspect of an industry. And we do also look at the price performance of the past. These all have to be considered. These historical performances will have a bearing on current market prices. Although past cannot be simply extrapolated into the future, it does provide some context. We also have to look at the competitive conditions in the industry. Competition determines an industry's ability to sustain above average returns. For a good investor, for a good analyst, we're not talking about averages. We're not talking about normal returns. We're talking about above average returns. We're talking about being stars. We're talking about turning into cash cows. We're talking about good results. If we have inflations at double-digit levels, we should be talking about returns way above all those inflations, way above all the value for time, way above all the value that we would consider to be worth investing into. The historical performance of the industry and the competitive conditions in the industry have to be looked into when we are narrowing down into good qualitative aspects of an industry. Now, we've talked about empirical research, we've talked about theoretical research. These all have the good bearings on deciding what industries to get into. By looking around at the market, by looking around yourself and looking around with trends, you're able to actually locate industries before you can actually do a fundamental analysis on these companies. So, you have to keep your eyes and ears open and look at the macro conditions of the country and the economy, what fads are coming in, what new industries are cropping up, and then you try to find out what is going to be the best thing for you to be investing into. Now, if we look at the Porter's competitive factors, we would be looking at influences on the return on investments. There have to be certain influences on return on investments, the ROIs. These basically are what? Threats of new entrants. When you're doing and talking about market penetration, you've always got to be looking at the SWOT analysis. You've got to look at the strength and weaknesses of an industry and the opportunities and threats that are lying out in the industry by way of new entrants. Threats and opportunities will be there, but you've got to weigh in the internal strengths and weaknesses of the industry you're focusing on as investing. Obviously, these forces will also affect bargaining power of the buyers because of competition and substitutes available in the industry. So it's good for the consumers, it's good for the buyers to be able to decide which product to buy from which industry. And then obviously there's rivalry that's existing between competitors. Now, if you've got substitute products or services available for one product or service, you'll obviously have an array of decisions to be making, what to buy and what not. We would also then be focusing on bargaining powers of the buyers, but we cannot overlook the bargaining power of suppliers as well, because the suppliers would also have a choice of where to deliver their products to. So this becomes now a complex situation where you're in the middle of a mess, where you'll have bargaining power and choices by the buyers, and then the suppliers would also have facility and think who pays you better, who pays you quick, who gives you the least bother, and then they'll be giving you products that you need or maybe delivering it to your competitor. So, in industry, profitability is a function of industry structure. When you combine all these things together, you'll be able to find out what industry opportunities lie. So you could either find out industry which is new, or industry which is giving you a new product, or maybe you could perhaps look at for a market to be developed for such an industry. Now, we could also not ignore governmental effects on industries, all the changes that keep coming in policies and regulations, the pitfalls of changes in regulations, the tightening of regulation, the interest regime and the taxes that may have to be paid from time to time may differ depending on governmental policies. Now, these policies have a significant impact and effect on industries and their ability to perform, the ability to exist, the ability to compete, and the ability to earn, and obviously their ability to pay out dividends. Now, the structural changes in how economies create wealth has to be seen as well. And developed countries in general and US in particular continues to move from an industrial to an information communication society. They are becoming service providers than producers. The industry is shifting over to communications and information services. The structural shifts can occur even within relatively new industries. We are seeing a transformation here as well as far as telecommunication is concerned. There's tremendous improvement in the information technology industry as well. Service industries are growing. Financial industries are on the up. And we might be looking at a slowdown on the industrial impact, looking at a global picture, where you've got extra choices available by way of imported products as well. When we're looking at taxes, when we're looking at opportunities and facilities available by way of new entrants from abroad, we have a great variety of choices in front of us, what to buy and what not to. When we're looking at the Porter's competitive models, we look at the threats available to an industry. We're talking about local industries. We're talking about industry being able to survive after having gone from the pioneering stage to the expansion stage, to the growth stage, or the maturity stage. What will happen when you've got similar products or alternative products available at a competitive price or a price less than what the industry is offering? So we need to be evaluating future industry prospects. What lies ahead? What is the forecast for long-term industry performance? That is what the investors need to be asking. Which industries are obvious candidates for growth and prosperity? That is what you have to think and look at. What industry is going to give you the best return for your investments? What industry is going to stay? What industry is going to fade out? What industry is going to grow? And what industry is going to become weak? That will be the question that investors need to ask. Which industries appear likely to have difficulties as a country moves from industrial to an information-based economy? At the click of a button, a mobile phone call away, you have tons of information available to you on the internet. We're talking about e-commerce. We're talking about business without frontiers. We're talking about globalization. We're talking about the right for an industry to survive on its own. We're talking about no more patronization of industries. We're talking about no more subsidies on industries. We're talking about an industry having the ability to survive on its own. We're talking about an industry being able to stand on its own feet and compete in the vicious competition available in the global scenario. This viciousness is going to decide what industries are going to stay, what industries are going to go down, and what industries are going to be the star performance of the future. The word that's keep coming up on all these conversations is information. It's communication, it's information technology in a big way. You have ready-made choices available by way of imported industries coming into you, by way of ready-made products coming to you, and then deciding what the local markets offer to you by way of competing the industry with foreign industries, whether internationally or regionally based industries. Since it's a free market economy, buyers and suppliers will have options who to buy from and who to sell to. Since we're talking about profitabilities in the short term, we need to be looking at what industries are we going to focus on. We need to be picking out industries for the next year or the year after that. So then the focus shall be which industries are likely to show improved earnings with good potential for growth. Estimate expected earnings and earnings multiple for an industry, because we're going to talk about relative growth strength with the industry and other industries. We're going to be talking about earning estimates notoriously being inaccurate. Which industries are likely to show improving price-earning ratios? Which industries are going to be showing improved earning per share potential? Which industries are going to be showing improved dividend per share? And which companies are going to be showing improved dividend yields? Investors tend to pay too much for favored companies in an industry. Blue chip companies tend to be the most costliest. You are willing to pay more money for established, strong companies which will have the ability to survive any sort of competition. They are the blue chips who demand a great deal of value for their price as way of stock confidence by investors. So you have to pick out industries which are going to be giving you improved earnings in future and improved price earning ratios. These are the variables that are seen as strong indicators of deciding which industry to get into by way of deciding future line of action for your decision making in investment opportunities. The industries that are going to be helpful are going to be maybe industries that are corporate, that are going to be responsible environmentally, which are maybe more giving you more emphasis on the greener part of your society, the environmental friendly companies, not the companies that are ozone depleting companies, but maybe ozone repairing companies, maybe they're lead free industries, maybe there are no companies with effluents or pollutants coming into the environment, or companies they'll be doing away with human resource, or companies that will not be affected by government or policy decisions. Those are the industries that you have to look at for the future. Now, the likely interest of interest rates and which industry is most affected by a significant rate change should be considered. Companies and industries that are not going to be affected by interest rates. Come what may, whatever the interest rate may be, they're not going to be affected by the industry. Industries most affected by possible political events also should be considered. Also should be considered industries with new technology. But inflation should also be considered, because this is all going to add up to the profitabilities of the industries. We talked about inflations and taxes and interest being significant hampering effects in the profitabilities of companies. Any change in inflation, any change in interest rates, any change in the tax regime, any tightening of the monetary policy, any changes in the fiscal policy, any political development, any political confusion, any political haziness is going to create confusion in what industry to be invested into. Now, all industries tend to start out as fascinating industries, but time tells us what these industries are going to be in the future, which we come to know through the stages of expansion and then maturity stages. Industry stages have to be looked out seriously, because the future of the industry is going to be the future of your required rate of return and the future of the potential of the earning capacities of these industries to be paying you as dividends. We're not investing for today. We're not investing for yesterday. We're investing for tomorrow and the future. Whatever has been happening in the past cannot be taken as a replicating effect on the future as well. Industries of the future are not going to be the industries of today, and we have to look at futuristic visions of industries that will be there to be invested into when you're talking about future investments. Now, the future, as we talked, is unobservable. So, we need an analysis of industries by their operating ability in relationship to the economy as a whole. Some industries move closely with the business cycle, others do not. Growth industries are an example in which earnings expected to be significantly above the average of all industries. Growth industry stocks suffer less during a recession. We talked about value industries. We talked about value investing. We talked about value stocks. We're talking about growth industries. We're talking about growth stocks and growth investing. We talked about comparisons between value stocks and growth stocks. The strength in value stocks, the comfort level with value stock, which is probably not there in growth stocks. Growth stocks will be the stocks of the future, with lesser historical information available in these stocks. Growth stocks are perhaps futuristic stocks, exciting stocks that will be taking up as a habit. Did you ever think about paying for water to drink? Did you conceive the idea 10 years ago? You must have laughed your head off that you'd be paying for water to be drunk. Did you ever think of buying water? Because water was supposed to be free. Water was always available from the taps. But we're talking bottled water. Who would have thought of paying water to be consumed? But if somebody had thought about that 10 years ago, would have thought about investing in bottled water. Did somebody think 20 years ago or quarter of a century ago to invest in home computers? Did anybody have an idea what the original computer looked like? How big a hall was required to house a computer? Did anybody envision what a computer would eventually look out like that you hold in your palms, or a laptop or a palm top? That is what futuristic growth companies are all about. We need to talk about defensive industries as well. The defensive industries are industries that are least affected by recession and economic activity adversely. Defensive industries are not to be confused with industries churning out defensive products like guns and ammunition. Defensive industries are industries that are immune to macroeconomic factors. Defensive industries would be industries that are in your life and blood on a day-to-day basis because you use products to survive. We cannot ignore cyclical industries. These cyclical industries are most affected by recessions and economic adversity. They're prone to outside factors, external factors affecting their earning capacities. So then you can be thinking about buying and selling these shares whenever the time comes. And counter-cyclical industries exist as well, which go against the cycle. Now, if we were to be talking about these industries which are affected by politics, which are affected by the slightest change in T-bill rates, coupon rates, discount rate, interest rate, taxes, could be avoided. Some of the industries are really industries that governments dwell upon for collection of revenue by way of direct taxes. Now, these industries will always be vulnerable to all new political regimes coming in so that they can squeeze out the last drop of profits from these industries. But on the other hand, I mentioned before, we have defensive industries which are more advantageous and immune from any outward pressures and activities. So, a good idea is always to get into industries that will not be disturbed by any sort of regime. And when I'm talking about regimes, I'm not talking about government regimes, but any sort of activity happening at the fiscal or monetary level. They'll just keep on growing. Or we could talk about interest-sensitive industries, particularly sensitive to expectations about changes in interest rates, maybe the financial sector, industries that will immediately be affected by any change in interest rates. These interest-sensitive industries have to be carefully analyzed. Careful analysis of business cycle and likely movements in interest rates help make better buy-sell decisions on the part of an investor. Industry knowledge is valuable. You must be knowledgeable about the industry as a whole to decide in selecting or avoiding that particular industry. We must know what game we are going to get into, where the pitfalls in the industry are, where you'll be able to reap the fruits of investment in particular industries. When you're talking about investments, we're definitely not talking about gambling. We're definitely not talking about going to a casino. We're definitely talking about investing in real financial assets. We're talking about investing in real, actual assets. So we've got to give a serious thought at the regime that will focus on your abilities to decide what industry to get into. But before we talk about getting into an industry, we must understand what the climate of the society is. Now, when we're talking about climates of societies, we're talking about business society and the climate in the country, in the region where you'll be investing. Growth industries, we talked about future industries like telecommunication and maybe information technology. Industries that will grow, industries that will deliver in future. And then we'll talk about the common stock, the company in the industry. That is where we'll be focusing on in coming lectures. So thank you very much.